Hello, friends. Welcome back. This is John Laxmi inviting you to another episode of my Zoom Out series. This is a series in which we take a topic and examine it by zooming out, by stepping aside and viewing it from multiple angles and getting a better understanding. In this process, we usually end up with even more questions than we started with, and that's okay. Indeed, that's the whole point of this series. Are you ready? Let's zoom out. Today's topic in the Zoom Out session is going to be of interest to everyone, I think, because we are going to be discussing money, wealth, capital, and capitalism itself. This topic was prompted by a friend of mine. She's got a degree in economics. She's well-read, and she asked me some questions, which I'm going to try to deal with in a global context by zooming out. The topic is the role of capital in the world and how capital is distributed around the world. It's also triggered by recent news that the United States is in decline, and therefore the United States dollar, which is the world's reserve currency, which is the currency used in most of world trade, may begin to decline. If the United States dollar is no longer available for world trade, what else is the alternative? We also know that China has been on the rise. Other countries like India have been on the rise. India is spearheading a movement generally referred to as the Global South, and there's a group of nations called BRICS, stands for Brazil, Russia, India, China, South Africa, countries like which are developing reasonably well in recent decades. Could these countries band together in some way and become much more independent and not dependent so much on the United States dollar? These are the questions that we'll take up, but in the process of zooming out, we are going to be simplifying this question. This is a very complicated topic, but in order to understand it in depth, we need to make it somewhat simple and devoid of all the technicalities that economics jargon involves. I'm not an economist, but I worked on matters relating to international finance, and I have actually worked in many of the countries that we're going to be discussing in this video. Now, to understand the role of capital and the availability of capital in the world, let's use a somewhat simplified chart. This is a chart where on the x-axis, we are showing the amount of foreign exchange available to various countries. Foreign exchange usually refers to the availability of wealth, external wealth. External wealth is earned by exporting goods and services to other countries in excess of imports of the country, or borrowing from other countries, or from international agencies like the World Bank, or from investments that come into a country, investments into a stock market of the country, or to businesses in the country. These are ways in which countries attract capital, which they can then use in trading with other parts of the world and in investing capital to promote their own economic development. So on the x-axis, we are going to be showing the availability of foreign exchange. So as countries displayed further to the right have more foreign exchange available, on the y-axis, going vertically, we're going to be showing the needs for foreign exchange. So countries that are displayed at the top of the screen generally need more foreign exchange than countries that are displayed at the bottom of the screen. So with that, let's look at the way the world is developed in terms of capital needs and capital availability. Now, let's start with the top left-hand corner, where we are showing two large continents, Africa and Latin America. These are very large continents with large numbers of people. vast amounts of natural resources available, and the people in these countries are willing to work hard, and yet they remain very poor because they lack capital. They lack external capital and domestic capital also, which is very limited. Now, contrast it with the bottom right-hand corner of this chart, where we're going to be showing a few countries which have surplus capital. We're going to explain why they have so much capital and they don't even need so much capital. You have countries like Saudi Arabia, Dubai, United Arab Emirates, and some of the Middle East countries which export a lot of oil and gas, so forth. And then in the middle of the chart, we have countries like China, India, Brazil. These are countries that have been growing rapidly, where people have been working very hard, exporting more and more. In the case of China, manufactured goods. And in the case of countries like India and Bangladesh, they've been exporting garments, leather, diamond, and IT services in the case of India in a big way. And they've been earning foreign exchange in excess of what they need for imports, as well as attracting capital into their stock markets and their local businesses. And therefore, they've got a good amount of foreign exchange amassed in recent years. And then in the top right-hand corner, you have a cluster of countries like Japan, Europe, the Great Britain. These are highly developed economies who have both strong exports and imports, and they have good amount of foreign exchange available for them. And then in the top right-hand corner of them all sits the king, United States of America. This is the one country which is a completely unique case in the world. This is a country which has been exporting more and more goods, manufactured goods, airplanes, machinery, technology, and others to other parts of the world, and has been importing large amounts of oil and gas from the Middle East, less and less so in recent years, but have been importing large amounts of manufactured goods from countries like China and IT services from countries like India. And in the process, in the last 25, 30 years, the United States has been importing significantly more and more than it exports. So America needs large amounts of foreign exchange to pay for the excess of imports over exports. How does it do it? The United States simply prints dollars, its own currency, gives it to the rest of the world, and the rest of the world is able to take that and use it for their import needs. They're willing to do this in ever-increasing amounts freely for many decades. This is what has led to questioning whether the United States of America and its currency, the US dollar, will continue to be able to do this in the coming decades, even though the United States itself is running a huge deficit in its trade. Not only in its trade has it been importing more and more than exporting, it has also been running a huge deficit in terms of its budget. The United States government spends significantly more than it takes in tax revenues, and the budget deficit is covered by huge amounts of borrowings, increasing amounts of borrowings. And in recent decades, borrowings not only from Americans, but also from outside America, from foreigners, from foreign countries, are also lending money to the United States. This is leading people to question whether this can continue. Now, at this point, let's pause a little bit and go to some very basics of economics. In economics, some of you who have studied economics and even others would have heard four major factors in economics. They are labor. Labor is the work of people, individuals working in farms and factories and offices. Labor is very important in economics. It has to be treated with dignity. It has to be paid fair wages. The second factor in economics is technology. Labor's productivity is enhanced by technology, And new technologies have continuously helped people produce more and more with doing less and less work. So technology is a very important factor in economics. Technology also must be carefully developed and responsibly developed, because technology can be quite damaging if it's not applied properly, and it can be quite life-enhancing if it is developed properly. So technology is a very important part of economics. The third factor that's important is natural resources. Land, minerals, oil, gas, iron, copper, all of these are very important for economics. And when we mine minerals and when we extract oil, gas, and others, we must do it in a sustainable way, in an environmentally responsible way. And then fourth is capital, the topic that we are discussing today. Capital is a very important part of economics, and capital is somewhat distinct and different from the other three factors, as we'll explain in this video. Capital, for a long period of time in human history, remained in the form of gold, silver, land, mansions, and so on, in royal kingdoms and so forth. But in the modern world, in the last 100 years or so, then increasingly capital means liquid capital, money. It's not gold and silver, really. It's money, currencies. You need capital to pay wages, to pay for machinery, to pay for technology, and so forth. So capital is a modern form of wealth. But this is different from natural resources and technology and labor in one important way. It's a little tricky. It can move freely, and it tries to go to wherever it gets better return. Just like we said, labor must be paid a fair wage. Just like we said, technology must be paid its due. And we said that minerals and natural resources must be carefully dealt with. Capital also must be carefully dealt with and paid its due. That's one of the main themes of this video. To contrast this, we're going to take two countries, which are very similar in many ways, but very different in some ways. Let's take Venezuela, very mineral-rich country. It's got large amounts of oil and gas reserves, and it's got iron ore deposits. So it's very rich and capable of very good economic development. Unfortunately, this country remains very poor. By contrast, let's take another country like Saudi Arabia, which is a desert, doesn't even have many of the natural resources that Venezuela has. It's desert land, but it's got oil and gas reserves like Venezuela. These two countries have dealt with their natural resources and labor, technology, and capital very, very differently. If you go to Saudi Arabia today, if you go to any part of the Middle East for that matter, United Arab Emirates, Dubai, Doha in Qatar, Bahrain, all of these places, what you will see is modern cities. They have skyscrapers, they have fancy airports, beautiful bridges and tunnels and roads, and they have hospitals, beautiful schools, mansions, and resorts. All of these they have built with the help of their natural resource. In the 1970s, oil prices shot up from merely about $2 a barrel to almost $30 a barrel by the end of the 70s. So during that decade, for the same amount of oil and gas they were exporting, countries like Saudi Arabia got almost 15 times the amount of money. Huge amounts of capital came in from the developed world, which was importing the oil from Saudi Arabia and other countries. When they had this vast wealth suddenly, what did they do with it? They took that and then they invited people from other countries, Asian countries, construction workers and others. They invited technology from Western countries and built modern ports. The Jebel Ali seaport in Dubai is a very, very modern seaport. They built a beautiful big seaport and then airports and all of the things that they have built with it. This is a very careful and respectful treatment of capital where countries remain open bring in resources from the outside if necessary. And in the process, the domestic population has also benefited enormously from it. Contrast it with Venezuela. They also have natural resources. They also need technology from the West. When oil companies like Exxon and others have gone to Venezuela to try to help the country extract the oil, refine the oil, and export it, repeatedly, Venezuela has treated these Western companies and their technologies with conflicts, with almost contempt, always getting into disputes with them and changing the terms and so on, with the result that if you go to Venezuela, you see that it's a country that has shanty towns, slums. The people are not happy there. Many of them are actually fleeing to Florida and other places. And this contrast between two comparable countries shows us how important it is to treat capital with respect. Saudi Arabia did it the right way. The OPEC countries in the Middle East have done it the correct way, and Venezuela has done it the wrong way. Now, we turn to the Middle Kingdom. In the middle of the chart, we have China, India, Brazil, and these countries who have worked very hard in the last 2-3 decades to build their economies, and they have amassed more and more foreign exchange. And that's a good thing because they do need capital. They have capital, but they need additional capital from abroad, and they have been gaining that by working hard, exporting more than they import, and attracting investments into their stock markets and into their businesses. And as a result, India today has $689 billion of foreign exchange reserves. $689 billion. That's a record amount for India in the last year or so. Every month, almost every week, they have been posting records in the amount of foreign exchange reserves. To put this in context, about 30 years ago, in the early 1990s, India almost went bankrupt. It had as little as $600 million of foreign exchange, with which it could only have the money needed for 6 weeks of imports. Today, India's position is far more comfortable. China has got even more. They have $3+ trillion of foreign exchange reserves that they have earned over the last 3-4 decades of exporting manufactured goods to the United States and attracting investments into China. And similarly, Brazil and others have gradually increased their external wealth, foreign exchange, to be able to grow themselves domestically. And then the far right-hand corner, we said there are these balanced economies like Europe, Japan, Great Britain, and others. They have been open economies through free trade with other countries, free movement of capital flows among themselves. About 25 years ago, the European countries thought that they could rival the United States. After the Cold War ended in the late 1980s, early 90s, it looked like for a moment the world was going to be at peace and economies worldwide were going to grow. And Europe thought that by banding together, they could rival the United States. Each of the European countries at that point had separate currencies. France had franc, Germany had marks, Italy had liras, and so on. They banded together and formed a common European economy and formed a currency called the euro, which is what we currently use. And they thought that the euro could rival the United States. No, it could not. It's been 20+ years since the euro was announced and introduced to the market. In fact, the euro has not been able to rival or even replace to a small extent the United States dollar. So this raises the question of why is it that different countries' capital needs are met differently? We saw that the African continent and Latin America have virtually no capital availability, but a very high need for capital. And then countries that do not even need all the capital they are getting, countries like Saudi Arabia and Qatar and United Arab Emirates and others, are awash in capital. And countries like China and India and Brazil are having to work so hard at it. And the United States can simply print its own currency and trade with the rest of the world. what are the differences among these countries that make capital so unevenly spread throughout the world. The difference among these countries, I would say, is the way we treat capital. As we mentioned earlier, just like labor, technology, natural resources must be treated with respect, capital also must be treated with respect. Capital can move around more easily than laborers can move around. Capital can move around more easily than technology. Capital can move around more easily than natural resources. And therefore, we must almost worship capital. We must respect capital, pay it its due. Capital earns a return in the form of interest when it's lent to others, in the form of dividends and earnings when it's invested in businesses. And we must respect this system, which is generally referred to as capitalist system. I would say it's called the capitalist system because capital is the most important part of the four factors of the economy that I mentioned earlier. And if we respect capital, then capital will respect those countries which respect capital. And in this sense, I would say the United States is able to have its unique position in the world because it remains the one country that has generally, relatively speaking, respected capital, respected owners of capital, rich people, businesses, and others who have capital more than other countries have. Of course, the United States also has indulged from time to time in capital controls. Notably, the United States gave up the gold standard where the currency is no longer backed by anything tangible. United States dollars is not backed by anything tangible. No gold, silver, or diamond backs it, and it's just a currency. And yet, it commands respect all over the world because the country respects capitalism. The country is open to ideas from anywhere in the world. The country is open to investors from anywhere in the world. America is open to businesses from anywhere in the world. America is open to immigrants from anywhere in the world. If America continues to remain open and respectful of capital, American currency will continue to remain supreme in the world as it is currently. But if we tinker with it, we too could be at risk. And we have done some damage to capital, especially in the last 10 years. In the last 10 years, our government, the Federal Reserve, has artificially kept the return on capital to near zero. Interest rates have remained zero for almost 10 years, unnecessarily for a very, very long period of time. It was necessary briefly after the financial crisis in 2008. It was necessary to bring down interest rates to very low levels briefly during COVID, but it was totally unnecessary to keep the interest rates so low for such a long period of 10 years. It is disrespectful of capital to artificially and arbitrarily and by fiat bring down the reward for capital. We don't freeze wages. We don't freeze the reward for technology. The government did not freeze the price of iPhones during this period. The government did not freeze the price of computers during this period. The government could not freeze the price of any of the commodities, natural resources. But capital alone, governments think that they can fool with by tinkering with the price artificially. And if we do that, capital will flee. And that's what actually happened during the last 10 years. When interest rates were artificially lowered to near zero level, capital tried to go to wherever it can find some returns. It went into new venture capitalists got a lot of money, trillions of dollars. Much of it was simply frittered away and given to startups that really didn't have much value. Stock markets went up, rich people became richer, but the economy did not get much in return for it. And therefore, capital is a very, very important part of economics. And rather than looking at money as if it's some kind of an evil force, we should actually look at it as a very powerful force, a very important force in the economics of nations. So, what can we learn from this for countries like China and India, the developing countries that want to become developed countries. Someone asked me recently about the Indian foreign exchange reserve position. It's so large, does it mean that India is now a rich country? What can it do with the foreign exchange reserves? The answer is, it's good to have a large foreign exchange reserve, but it's not something that the country can be comfortable with, because just as capital came into a country, it can as easily go out of the country. External investors who invest in the stock markets of countries like India and China can easily take the money away. And so import-export balance can quickly change. And therefore, capital must be preserved. More importantly, they must build good relationship with those countries from whom they were able to get this capital. Where did this capital come from? India's large foreign exchange reserve primarily came from Western countries to whom it exported its goods and services, IT services, diamonds, leather, garments, and so on. And it must build strong bridges with those Western countries. Is India doing that? Unfortunately, India is doing the opposite. In the last couple of years, as Russia came under sanctions from the West, Western countries did not want countries to buy oil from Russia. India defied the West and is continuing to buy oil from Russia at about half the price. Great discount, wonderful bargain, and it's very good short-term benefit from India. However, this is a short-term benefit that will not translate to long-term benefits, because in the long term, the next 30, 40, 50 years, what can Russia give to India in return for buying oil during this war? Not much at all. Whereas stronger relationships with the Western countries, developed economies of the world, can give India and Indians significantly more economic development, growth, and capital that it needs. The same is true of China. China is sitting on $3 trillion of foreign exchange. And it must also preserve its relationships with the West, because most of this capital came from the West. In fact, what is China doing with these $3+ trillion of foreign exchange reserves? Most of it, China is not able to use it in its domestic economy. It is not using it. Why is it not using it? Because it doesn't have the institutional wherewithal. Its governance structure, its government structure is unable to use this capital to significantly improve the life of all Chinese. Chinese are much better off today than they were 20 years ago, but they could be significantly more better off. But China is not able to do that. Instead, what China is doing is taking this $3 trillion and investing it in US Treasury bonds. In effect, what it means is China is lending money to the US government, which is fine, because the United States government is borrowing money, as I mentioned very early on. Who is it borrowing from? It is borrowing it from countries like China and India and other countries. So indirectly, we could think of this as a somewhat perverted system where people in countries like India and China are working for the West. They're working very hard to earn foreign exchange, which is now earned by these countries and being lent back to the United States government, which is not a very good idea if you think about it long term. India and China and others should be developing institutions to take this foreign exchange and use it to build modern hospitals, laboratories, schools, and other infrastructure that their own people need. But that will be a long process. It will take a long time. Institution building is not as easy as infrastructure building. Infrastructure buildings are just buildings. Institutions involve people and principles and others. That's another topic for another podcast. But the main theme of this video is to point out that capital is a very important part of economics, and we are often mistreating capital. And we must change this all over the world, including in the United States. And if we do that, more capital will flow to where it's needed. Africa and Latin America need a lot of capital. They want to attract capital. They must welcome capital. They must welcome capitalists. And if they do that, these continents too can develop. Now, one final important footnote to the story about capital. We saw in the comparison between Venezuela and Saudi Arabia that these are two comparable countries, and yet they ended up completely differently with respect to the availability of capital to them and the country's prosperity. But in the process, you would have noted that neither country is really governed by a democracy. Saudi Arabia is an autocratic monarchy, and Venezuela is a dysfunctional democracy. And yet, capital made a difference to these two countries. From this, we must learn a very important lesson. Capital itself is somewhat agnostic to politics. By simply being a democracy, you cannot necessarily attract capital. And by being a dictatorship or an autocracy, it doesn't mean that capital will not come to you. What is really powerful is the combination of both. In the United States, in America, we have the best of both. We respect capital, and we are the most open democracy. And that is the reason the United States dollar, the American currency, continues to be most widely accepted in the world and will continue to be so for the foreseeable future.